Good morning, ladies and gentlemen. Welcome to the Henderson High Income Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, I would just like to submit the following poll, and if you'd give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to Portfolio Manager David Smith. David, good morning, sir.
Good morning, and thank you. Good morning, ladies and gentlemen, and thank you for listening in. So I'm David Smith. I'm the Portfolio Manager on Henderson High Income Trust. It's a trust I've been involved in since 2012, and effectively it's an investment trust that invests in UK equities and bond securities, and the objective is to generate that high income for shareholders, but also the prospects of capital growth into the longer term. So I'll give a broad introduction into the trust. I'll talk a little bit about the market outlook as we see it, and then give you talk about a few stock examples that we own currently and why. And then obviously we're open up to Q&A at the end. So, why do we want people to invest in high income? Well, as I suggested, as the name suggests, it generates a high level of income, but in a very diversified way. So if you look to the chart on the left-hand side of the slide there, it really does highlight the attraction of that dividend. It compares the dividend yield currently on the trust versus certain other asset classes, whether that be the main UK equity market in the FTSE All-Share, whether that be 10-year government bond yields, or whether that be where current interest rates are. We have a yield that is superior to all those other income yields on those asset classes as well. But we generate that yield in a very diversified way. So if you look at the chart on the right-hand side there, it just shows you the contribution of income for the FTSE 100 from the top 20 income-paying shares. So as you can see, for the FTSE 100, those top 20 income-paying shares or companies actually pay out 75% of the index income. For someone like Henderson High Income, those top 20 shares actually only contribute about 30%. So we generate our high-level income in a much more diversified way than the overall UK equity market. So a bit of background in terms of Henderson High Income. As I said, it is a UK equity and bond income trust. Our typical split between equities and bonds is 80% in equities and 20% in bonds. And I think that really is kind of our unique feature. Most other UK equity income trusts are just equities, whereas we do have that ability to own bonds. And I'll talk about that in a bit more detail on the next slide. We are a well-established trust. We were launched back in 1989. We've grown to about 360 million of gross assets. We are very much bottom-up stock pickers, so trying to look for good quality companies that can pay and grow their dividends. And that really is a key focus for us, not just about owning companies that pay dividends, but own companies that pay a dividend that can grow into the longer term as well. We have classified as a AIC, Next Generation Dividend Trust, and that's because we've grown our own dividend by more than 10 consecutive years. And again, I'll show you this on the next slide. We've actually grown it 11 consecutive years. So as I said at the start, I've been on the trust since 2012, and since that time, we've been able to grow our dividend at a compound average growth rate of about 2% per annum over 11 consecutive years. Now, what does that mean? What does that mean to the actual end investor? Well, if you were to invest £10,000 in the trust back in 2012, actually we would have paid you back £7,500 just in dividend. So effectively a 75% return just in income, just in those dividends. Now, and that also ignores the capital growth we've seen as well. So actually the NAV over that time, just on a capital performance, so excluding those dividend returns, actually that NAV has grown 42% over that time period as well. So you've got a high and growing income, a very attractive income in my mind, but also you've had capital growth over that same time period. It is an investment trust. So one of the key advantages of investment trusts is our ability to use revenue reserves. So these are excess income we generate in a year that we can store up for for when income is particularly scarce, as we saw during the pandemic in 2020 and 21, to be able to smooth that dividend payment. So revenue reserves, where they are today, cover about 50% of the dividend payment going forward. It actually puts us in a pretty good state, pretty good position, continue that, paying that dividend and paying that, hopefully growing that dividend at the same time going forward. So as I said, one of our unique or differentiated aspects is our ability to own bonds. And that certainly should be seen in the context of the gearing within the trust. So what do I exactly mean by that is, well, we have got some long-term fixed rate borrowings. Again, a key advantage of investment trusts over open-ended funds is we have that ability to utilize borrowings or gearing. So we've got long-term fixed rate borrowings at a blended rate of 3.67%. And actually, if we can invest that in a stable portfolio of bond assets yielding more, that's a good way of generating that extra income for the trust. And that's very much a structural element of the gearing. What else does a bond portfolio bring other than helping benefiting and boosting that headline dividend yield? Well, actually, it provides resilient income as well. In more macroeconomic challenges, bond income or the coupons that the companies pay on their loans are actually a lot more stable than dividends. So again, it provides that resilience of income to the portfolio. It also offers diversification. I talked about that earlier in that chart. Really, being able to generate income from other assets rather than just equities, again, helps diversify that income source if we do go in a more challenging macroeconomic environment. And then also it dampens down volatility. So generally bonds are a lot more stable than equities. So again, it helps dampen down that volatility. So although we've got that gearing that affords and supports that bond portfolio, actually because bonds are less volatile generally than equities, it actually helps dampen down the overall volatility of the trust there as well. So moving on, talk a little bit about what we look for in companies and what the stock selection process involves. Well, in short, what we're trying to do is find good quality companies that effectively can pay and grow their dividends in the long term, but making sure we're not going to overpay for those types of companies in terms of valuation. So I break it down into a sort of three-stage process. So firstly, it's about fundamentals, really understanding what a company's key attributes are. So, I want to know what a company does, how it does it, how it's positioned in markets, and what the dynamics of that market is. And I guess the key things I'm trying to look for are, I want a company with a robust business model, a company that's going to be around for the very long term, 10 years plus. It's not going to be able to be competed away from, traditional competition or new, digital or tech businesses, etc. I want it to be a stable business for the longer term. So you're looking at, how it's positioned in its markets. Is it a market leadership? That's what we like. Affords pricing power, etc. Does it have high barriers to entry? Again, key to make sure it can't be necessarily competed away. And good management teams. Going through the pandemic, it showed us what the quality of good management teams really bring to a company, being able to negotiate tricky, hard times that we haven't necessarily seen before. So it's good. It's good to really meet those management teams of the companies we invest in to make sure they are devising a key and sensible strategy to grow the business into the longer term. Then the next part of the process is really analysing the financial health of the business. Looking at the cash generation. Does it have a strong balance sheet? Does it have a well-invested asset base effectively? And, combining both the fundamentals and the financial health, you get a very good insight into whether a company can not only sustain their current dividend, but grow it into the longer term. And those two key elements are very important for the long-term total returns for a company, dividend yield plus dividend growth. And then the third part of the process is really valuation. And this really underpins the whole process. It's all very well finding a good quality company with good financials, with strong financial health. But if the valuation is not attractive, then your capital appreciation is rather limited. It's about finding good quality companies with strong or improving financial health that you think is undervalued. And that's really the key for us. I talked about the importance of not just focusing on dividend yield, but also the importance of dividend growth as well. And I think these two charts really do highlight that. The chart on the left is really highlighting why you've got to be careful to not just focus on dividend yield. Despite the name Henderson High Income, it's not about investing just in companies with the highest dividend yields. This chart really shows the black bars show you what you thought you were going to earn in dividend yield at different levels of dividend yield. And actually the orange bars show you what you actually got. So actually the higher the dividend yield there is, the less likely you are to actually earn that dividend yield. And actually dividend yield in isolation can be a misleading guide to value. So I always say, if you look at companies that have a dividend yield between 2 and 4 and 4 and 6%, actually that's kind of in the sweet spot in terms of those dividends being a lot more sustainable in the longer term. And that's what history has taught us. If you look at the chart on the right-hand side there, those two dividend yield ranges, that 2 to 4, 4 to 6% dividend yield range, actually historically has produced the best total returns. So that's why I call that 2 to 6% range in total is a sweet spot. Dividends are much more secure historically, and actually that area of the market has generated the best total returns. And that's because those companies pay a good or appealing dividend yield, but also are able to grow in the longer term. And those two key elements together form the majority of a total return historically. The next chart is just looking at the long-term performance track record of the trust. I probably won't dwell on this slide too much, but we have, since I've become portfolio manager on the trust, we have significantly outperformed the benchmark and had a good return, in line with the benchmark over 1 year, but certainly ahead of it over 3, 5, 10 years, and actually the longer term as well. It's probably a good time for me to be out there talking to you, because one of the other elements of investment trust is that you do have these situations where you trade or the share price doesn't necessarily match the net asset value of the trust. And that's one thing we're noticing across the wider industry at the moment, but specifically for Henderson High Income Trust, where if you look over the last few years, we've generally traded quite close to our net asset value, but actually that's gone to quite a big discount, around about 10% as we are today, more recently, as generally I think UK equities have gone out of favour as well. But if you believe in the trust, believe in the value of that NAV, then actually this could potentially look like a good buying opportunity for investors there as well. So that was a broad introduction to the trust, but I'll talk a little bit about our market outlook. And I think we're kind of cautiously optimistic, I kind of phrase it, in terms of our market outlook. I think if you look at economics forecast for the UK economy for this year, they're around about 0.3%. That's versus trend growth of about 2%. So it does feel like everyone's quite bearish out there. But I think those bearish economic forecasts are too negative, I would suggest. If you look at wage growth in the UK, actually wage growth at the moment is outstripping inflation. Wage growth is still coming through quite nicely at the moment, whereas other inflation is starting to fall. So actually wage growth being ahead of inflation actually means you are going to see real wage growth, which is generally positive for economic growth going forward. If you look at the chart on the right-hand side there, actually confidence is coming through again. So if you look at consumer confidence, actually that has been recovering for quite some time now. Again, as those inflationary pressures are starting to subside, you look at your energy bills now, they're starting to come down, etc. as well. And who knows, we think, over the next certainly 6 to 12 months, we're expecting interest rates to start being cut. Now inflation is less of a problem for the Bank of England coming through as well. The black bar on the same chart, shows business activity levels, both manufacturing and service industries. Actually, you're seeing a bit more uptick in terms of that activity levels, back towards more expansionary territory. So again, things are slowly improving. So I think that's kind of those two things I'll point to that actually make me a bit more positive than where forecasts are currently. That's not to say I think it's going to be a booming economy, far from it, but I certainly think it's going to be better growth than the forecasts out there, the gloomy forecasts that we're seeing currently in the marketplace. Next couple of charts just talk about performance and valuation in the UK market. If you look at the chart on the left-hand side there, just shows you there's been a huge divergence within the UK market. So the FTSE All Share over the last 2 years or so is up about 12%. But that's really been driven by the top 20 companies within the FTSE 100. So basically, the 20 largest companies in the UK have actually gone up as a group by 30%. If you look at the rest of the portfolio that's kind of been shown by the blue line there, which is the FTSE 250, so mid-cap area of the market, actually that's down 10% over those 2-year period. So they've really been hit hard by, increase in interest rates, slowing economic growth, etc. It's where some of the more domestic companies are situated in that mid-cap area of the market. So there's been almost a 40% performance differential between those top 20, those largest 20 companies in the UK market versus the more domestic cyclical companies in the FTSE 250. That's why if you look across to the chart on the right-hand side there, it just shows you valuations across the space, both in the FTSE 100 and the 250, are quite a low level at the moment. As you can see from that chart, we're in territory we haven't been for some time now, only cheaper in the GFC. And, I don't think the economic environment is as bad as we saw in the GFC. So I think there is huge value across the market cap space within that, within both the large cap and the smaller cap area of the market. Now, also the valuations of the UK market, very different from overseas markets. So, we're not just cheap versus our own history, we're cheap versus the US market, versus European market, etc. And I think when you speak to other people, other investment professionals, they will point to the fact that the UK market, you're lacking big growth companies. Where's the growth coming from? You're just boring, dull, mature companies in the UK market. Well, actually, I'm kind of trying to get out there to say, dispelling that myth, really. We do have companies that can grow. And I've got a couple of examples of ones we own in the portfolio. So the first one is 3i. So it's a private equity group, and its main holding within the company is a holding in Action, which is a discount retailer across Europe, really. And it's been growing phenomenally well and successfully over the last few years, really. You can see it there on the chart on the right-hand side there. So the profits have grown by almost 900% over the last 10 years. And it's a really attractive business model to us. Effectively, a discount retailer, it limits the number of products it sells, so it's got huge buying power in terms of its suppliers. One of the interesting stats is it's Coca-Cola's biggest customers across Europe. So using that buying power to get discounts on the product, it can then reinvest in price for the consumer, i.e. lower the price to the consumer, brings in more volume in the store, then has to buy more from the supplier, and then gets bigger savings as it grows as a business. And that becomes a self-fulfilling business model as well that continually invests in price. It's been a huge success across Europe, huge more growth going forward. So it's up to about 2,500 stores. And we think that store estate can probably double over the next, or more than double over the next 10 years. So again, very good growth business that's got huge more growth to go for. But you just have to be able to, in the UK market context, have to look for these sort of opportunities within the space there as well. Another example, probably a smaller company within the portfolio that we own, is Cranswick. Maybe some of you heard of it, but essentially it supplies pork and chicken-based products into UK supermarkets. So think your gourmet sausages, bacon, cooked chickens, etc. This is a very well invested business. Because of that investment that's continually gone in, actually it's a low cost provider. So it's been winning a lot of market share off the competition that haven't been invested, don't have the same reputation for quality, for service, for cost. And essentially, because of that, it's grown very nicely over the last 10-year period. Not quite as fast as Action, but still growing your profits by 164% over that time period. That's huge growth for a company of its size. And again, there's huge opportunities for that continued growth. It's recently signed a contract with the likes of McDonald's, where it's going to be again, provide those chicken-based products to McDonald's, and that can expand over the next few years and win more share, more contract, more content for what McDonald's sells as well. So a good business. Again, continued investment for those growth opportunities at good good returns for shareholders as well. So again, it's a company we like, company we've obviously been investing in for some time, but continue to see the good growth opportunities as well. So hopefully that gives you a feel. There's a lot of negative sentiment around the UK equities at the moment, the UK market. But if you look close enough, there are some very good quality, good companies that are paying attractive or appealing dividend, that are growing very quickly, that maybe some of the people have missed out there as well. I've talked a little bit about the discount the UK market trades at relative to global indices, and you can kind of see that on the chart on the right hand side there. The MSCI World ex UK valuation on a price to earnings basis is 18 times now. Again, you look at the FTSE All Share, we're down 11 times, so there's a huge differential. But if you look at the chart on the pie chart on the left hand side there, this is the underlying geographical exposure of the portfolio. So an investment in the UK market, or certainly Henderson High Income, is not necessarily an investment in the UK economy. The UK market is a very global market in terms of where companies generate the revenues and profits from. Again, Henderson High Income, similar to that, we are very broadly diversified in terms of the companies we own and the geographical exposure of where they get those revenues and profits from. So you effectively still investing in the UK market, investing in Henderson High Income, you are getting underlying global exposure, but you're getting on a UK discount, given where the valuation is trading relative to global indices. And also given that, our own discount on Henderson High Income is at minus 10%, effectively you're getting double exposure on a UK discount on a second discount as well, which I think is rather attractive at the moment. Next slide just talks about current positioning. Pie chart is just our sector exposure. Again, broad diversification in terms of some of the exposures we have there. The two biggest sort of sectors there, consumer staples, so everyday items provide that stability. Pretty defensive holdings there, offset by probably a similar sort of weighting in financial, so more cyclicality, etc. as well. But good broad diversification as well. And then you've got the top 10 holdings there on the right hand side as well. There's some balance between defensiveness, bit of growth businesses in likes of RELX, 3i that I spoke about, but also some cyclicality as well, like some NatWest, Rio Tinto there as well. And then finally, I guess just a recap before we open up to questions. So why Henderson High Income? As I said, providing a high level of dividend income, but also a growing income stream. So 6.6% dividend yield. That's grown about 2% compound annual growth rate over the last 11 years consecutively. I do sit in a very experienced team at Janus Henderson that really do focus on not just income funds, but income investment trusts. And we do have a very clear focus on making sure that we own companies that provide income stability. So, focusing on dividend growth as well as dividend yield, but also having revenue reserves there to protect the income going forward if we do get into more difficult environments for income. And then the long-term track record definitely does sort of stand out in that regard. But I'll leave it there and open it up to any questions you may have.
Perfect, David. That's great. And thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the company takes a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. David, as you can see there in the Q&A tab, we have received a number of questions throughout your presentation this morning. And thank you to all of those on the call for taking the time to submit their questions. But David, perhaps if we just dive straight into it, the first question that we have here reads as follows. Considering the macroeconomic outlook and the possibility of interest rate cuts in 2024, how is the company positioned to capitalize on the potential opportunities in the market whilst managing the associated risks effectively?
Sure. So I think one of the things we did back in Q4 last year was actually we started positioning the portfolio more towards cyclicals and more towards those sort of companies that probably benefit in an interest rate cut environment. So, we had new positions in the likes of Taylor Wimpey, the house builder, trading at a discount to NAV at the time, very high dividend yield. We thought that could be sustainable. We also bought into British Land, new holding, the real estate company. Again, it feels like a lot of the value or sort of real estate values was troughing at that level. You're starting to see rental growth come back again, trading at big discounts to its NAV. And if you get certainty of that NAV, again, I think that could be a good environment. Added to a few other names there, bought into the Dunelm, the homewares retailer, again, and improving, consumer outlook, consumer housing, improving or recovering housing market, etc. As interest rates are cut, again, going to be boom for that sort of company. So we have been shifting the portfolio more towards, cyclicality, those companies that can benefit from interest rate cuts. It's not a one-way bet. Having, been doing fund management since 2007-8. I recognise that we've got to still have a broad, diversified portfolio to manage some of those risks, because not all companies in this sort of tough economic environment are going to do as well as others. So you need to be careful about not putting all your eggs in one basket, keeping that broad diversification. But it's at the margin. We're shifting that portfolio. We've been adding to those names we think can do a little bit better there as well.
Perfect, thank you. Just turning to the next question that we have here, which asks, why is the gearing at 22%? How is this funded? With RCF, what rate?
Yeah, so the gearing, there's two elements of the gearing. So the first part is the structural gearing, which is the gearing that backs the bond portfolio. So currently we're invested 15% in the bond portfolio. And then once you strip out that element of structural gearing, the gearing that goes in towards the equity portfolio, that's around about 7% at the moment. So together, that's the 22%. So we got two forms of debt in the trust. So firstly, it's a private placement debt, so fixed rate borrowings out for another 15 years at 3.67%. So that's fixed rate. And the other portion of the debt is through our RCF. We're paying a margin of about 88 basis points over SONIA. So pretty competitive margin. And clearly, if interest rates cut, then our interest charge will come down in that facility as well. The split between the two, we're about 40% in the fixed rate borrowings and about 60% in the RCF.
That's great, thank you. The next question asks, the trust has seen its NAV discount push out to around 10%. Presume this has been in part due to the recent merger with HDIV. Is the board looking to reduce this divergence in the near term?
I'm not sure it's specifically a direct result of our merger with Henderson Diversified Income Trust. Which got completed in January. We had already moved to a 7% discount prior to the merger becoming effective. And actually, if you look across the wider investment trust space, actually you've seen discounts widen across the piece, both in terms of the alternative space, which obviously big discounts, but in terms of the mainstream UK sort of equity space as well. And we're not out of kilter with the AIC UK equity income sector. That's in an average discount around 10%. So we're kind of in line with the average. Are the board looking at ways to bring that discount in? Yes, it's a topic for board meetings. We certainly discuss it a lot of times. I think where we are today, in line with the sector, I don't think necessarily we're thinking about doing buybacks. I think we're going to explore other ways to try and bring that discount in and just create more buyers. And that's through, doing more marketing. We've had, a relaunch of the website recently. We have got a big ongoing advertising campaign just launched recently. Exciting times, I think. That's the way you can stimulate that demand, because we think it is a very attractive proposition given the dividend yield, given the dividend growth, and actually given the long-term performance track record of the trust. So I think there's ways we can do it. Now, clearly, if that doesn't work, then there's alternative ways we can look at it going forward. But I want to try the marketing side first before we think about alternatives.
Perfect. Thank you. The next question that we have here relates to dividends, and it asks, can the dividend be maintained and increased over the next 3 to 5 years?
I think, given what can I say about the dividend without giving too much forward guidance? We do a lot of stress testing in terms of different scenarios for our companies and where it can go over the next few years. And I produce that to the board at every board meeting there. We have a very broad, diversified portfolio. As I said before, it's not just equities, it's bonds as well. And bond coupon is a lot more stable, more resilient in downturns than equities. And plus, we've got those revenue reserves. So we've got 50% of the dividend is covered in by reserves. So that gives me confidence. So there's no reason with those examples or those reasons why we shouldn't be able to continue to pay and hopefully grow the dividend to the longer term. We're proud of that 11-year consecutive track record, so we're kind of keen to push it on, I guess.
Perfect. Thank you. The next question asks, during a bear market, are you able to stay in cash, or do you have to be fully invested at all times, or would you change the mix of bonds to equities?
Yeah, I mean, certainly we've got a lot of flexibility in what we can do. I think one of the things we'd probably look to do first, if we did think that we were going to go into bear market, was probably shift more away from equities and certainly utilize bonds first. In terms of the level of cash, we can certainly lower the gearing, definitely. I think there will always be a little bit of gearing just to structurally fund that bond portfolio and get that extra income for shareholders. But certainly we can play around with the actual level of gearing. But I think the first protocol will probably be changing the asset allocation between bonds and equities. If I think back to, over the lifetime of the trust, where we are at 15% in bonds, we've been high as 35%, probably before my time. But certainly that's the sort of level we have got up to in the past. And, if we are worried about equities, then certainly that's an area, that's one aspect we can use, and that plays that flexibility, as I mentioned.
Thank you. Just turning to the next question. The report says ICG was a significant contributor. Was the contribution a one-off, or does it fit in with the 2 to 4% dividend yield that you described as sustainable and ideal for long-term returns?
Yeah, so ICG or Intermediate Capital Group, it's a business we've owned for a long time, to be fair, over 10 years, I think. And it's a very good, high-quality business and it's just, it's basically market leader in specialized niche. It does private credit, but very much the mid-market area, which not a lot of the big guys play into. And they have very good, strong, long-term track record. So it's an asset manager, private credit, very good long-term performance track record, grown really well as it's become a popular space in the alternatives area of the market. And through that growth, it's generally driven that huge dividend growth over the same time period. So it used to be a big high yielder for us. And obviously, as that dividend yield has come down, as the shares have been very successful. But given we've got certainty over actually the dividend growth is still going to come through, we're kind of happy to hold it. So it's been a very good long-term successful holding for us. Given the prospects of the business and the asset class going forward, I'm still happy to hold it from here as well, because I think there's still value, there's still good upside from where the current valuation is.
Perfect. Thank you. And just turning to the final question that we've got here, which asks, what is the dividend cover?
Yeah, so in terms of dividend cover, in terms of the revenue we generate versus the dividend we pay out of, we were fully covered last year. So we paid out around about 98% of our income. Typically we are an income in trust, so we're going to pay out the majority of our income out as dividend. But it's a good place to be in terms of the last 2 years, we've fully covered the dividend as well. Clearly in 2020 and 21, when we went through the pandemic, where we saw big dividend cuts across the market, we had to utilize a little bit of revenue reserves to pay out. But actually, over the last 2 years, back in 2022 and 23, we've been back covering that dividend fully. And, I suspect going forward that's a place we would like to be, put in a little bit of extra income back into those revenue reserves, for the next downturn to come, whenever that may be.
Perfect, David. That's great. And thank you very much indeed for being so generous with your time then, addressing all of those questions that came in from investors. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the platform. But David, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Yeah, I mean, it's just to thank again people for taking the time out of their busy schedules to listen in to me. If you want to know more information about the trust, then please do visit the website. It's a brand new website, only launched a couple of months ago. So please get on there, and there's a way to sign up to communications going forward from the website if you're interested. And I'll advise people if they are to please have a look out for that.
Perfect, David. That's great. And thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Henderson High Income Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.